Fook Hien, Senior Investment Strategist at Standard Chartered Bank, is with us on the show now. Fook, morning, and thank you very much for joining in. Well, the earnings season in India is done, and it's largely over in the United States as well. If you had to look at the next 3 months for the global markets, how would you expect markets to behave? What would be the key triggers and the direction it's going to take?
Yeah, thanks very much. I mean, there's been a lot of talk about your seasonal strength and whether you get a Santa Claus rally. We have written recently that we think it is a fair chance that we can see the market rally continuing in the US. I mean, we laid out a few conditions. One was for the inflation to remain subdued, and we saw the CPI print there has been coming down. You know, especially core inflation ex-shelter has been coming down close to the 2% pre-pandemic level. So that is good and a boost for the market. We're also looking at the bond yields coming down, being subdued, and that's especially important for the growth sectors. And the US equities is very heavy in the growth sectors. A third factor that we point out is the risk in the Middle East, whether the conflict there, as long as it remains contained and doesn't spread in terms of how it could impact the oil prices and the oil market. We think if that factor is being contained, then the setup is still positive for the market recovery to continue since the lows at the end of October. I mean, the US market has went into a correction, and now the positioning is still quite low. We think that's favorable for the US market to continue in the near term for the next 3 months, and broadly for the global risk assets as well. We think it can continue for the next 2 months.
Okay, that's a fairly positive view that we're waking up to, Fook. Thanks a lot for joining in. So you're saying that the US markets are favorable and it's a positive situation for global risk assets. Got that. We have the FOMC minutes that come out later this week. What will the Fed minutes say about the path for US interest rates, according to you?
Yeah, I mean, the Fed is still very cautious. I mean, you've got a few Fed speakers. Some of them are a bit more hawkish, some of them a bit more dovish. But we think that, Chair Powell himself is still very cautious. He's not ready to say that rates cuts are coming. We need to see data. We're going to be very dependent on data. So I think we'll see a bit of that debate coming up in the minutes. The markets are already pricing in, and bear in mind, the Fed has seldom disappointed the markets, if ever. And the market's already pricing in one rate cut by June next year, and then by two by July next year. I mean, our view is that you could have up to 3 cuts by September next year. So the outlook for the next few months, we think, is positive because of positioning, seasonal factors. But looking into next year on the 12-month view, it's still a big question whether we get a US recession or not. There's very mixed views out there. I mean, our view is that on balance, we still think it's likely we get a recession because of various factors. The consumer is weak, and then your long and variable lag in terms of interest rates coming through. But that's next year. And then the Fed minutes, we think, will be very cautious as well about the risk of whether you get a recession coming in next year as well. So on a 12-month view, actually, we have a neutral view for global equities. We do prefer the US. We think the US can outperform. The US equities is kind of it's very much driven by all your tech companies, which are very large, and it's slightly different from the domestic US economy, where consumers can be a little bit weak, but we think that the US equities can still outperform because of the tech companies that's been leading the market there. So on a 12-month view, we're still cautious of the recession, but we think that the Fed will still be cautious as well. We need to see a bit more weakening in terms of the job market data before we think the Fed will be a bit more open into saying that, yes, we'll support the economy next year with rate cuts if that happens. But we're not quite there yet, we think.
All right. Hi, Fook. Good morning. I recall the last time we chatted, you said that maybe you believe that the recession that we're anticipating could have been pushed by a couple of quarters, to early 2024. But I get the point that you made that now you're factoring in, I think, 3 rate cuts from the Fed, in 2024. But what's the view on India? When we spoke, it's somewhere in the middle of 2023, you were tilting towards India and, towards Asia, actually. And the top markets you were looking at was China, India, as well as Japan. Tell us, from the Asian market basket, where does India feature now in the pecking order?
Yeah, thanks very much for that. And good thing you remember that. Quite honored. But within Asia, our preference right now actually is with Japan. We think Japan has got some structural factors inside it, which is beneficial for Japan. And the flows, investor flows, foreign flows have been coming in. It's still very underweight in Japan. We think that's going to be supportive for Japan. Now, excluding Japan, we are looking at it being quite diversified across Asia ex-Japan. So India is neutral within our Asia ex-Japan basket. We are telling investors to be diversified across India, China, Korea, Taiwan, very different factors in there. We think India's medium-term growth is still fantastic. The earnings growth there is fantastic. And we do like that. Valuation is always a thing there, but the earnings growth and the macro economy, we think in India is good. And the rate hike cycle as well, we think has come to an end. But our view within Asia ex-Japan is to be diversified across India, China, Korea, and Taiwan. And these markets, they have different drivers behind them. China is very, very cheap, right? But we're still waiting for news flow to turn. And then the tech-driven economies like Korea and Taiwan, we think the cyclical side of the semiconductors, we think it's picking up into next year, and the trough actually is behind us. So to be diversified across Asia ex-Japan.
Okay, thank you very much, Fook, for joining in. Like India, but in the Asia ex-Japan portfolio, the strategy would be to have a bit of a diversified portfolio with a play on China, Korea, South Korea, Taiwan, and India.